indeed to all participants in today's Tax Outlook webinar for 2023. My name is Shem Otanga. I'm a partner at Cliff Decker Hoffmeyer in the Nairobi office. We're delighted of you joining us. We're excited about the level of engagement and participation that we have seen so far, and are looking forward to a fruitful discussion this afternoon. Just a brief introduction about our law firm. Cliff Decker Hoffmeyer is a full-service law firm with offices in South Africa, as well as, of course, here in Nairobi. The Nairobi office is 5 years old, having merged with Cliff Decker Hoffmeyer in 2021, so 2 years post-merger now. We practice in several areas, including corporate and commercial law, tax law, obviously, dispute resolution, technology and IP, as well as environmental law. But moving on very quickly to what has brought us here today. We have a panel of erudite speakers, 5 members of our panel this afternoon, and I'll quickly introduce them before passing the microphone, so to speak, to our panelist, our panel moderator rather for today, who's Alex Kanye, who will introduce at the very tail end. But starting off is Josephine Mugure, who is the Chief Manager, Budget and Technical Support under Corporate Policy at KRA, the Kenya Revenue Authority. Josephine is a member of the National Budget Team and engages key players such as the National Treasury and the Parliamentary Committee on Finance and National Planning by contributing to significant national tax policy matters such as finance bills and also subsidiary legislation. She also works on international tax policy matters with organizations such as the OECD, ATAF, and the UN, and she possesses a wealth of experience with regard to tax policy and legislation. Welcome, Josephine Mugure. Our other panelist is Alex Oguso, who's a senior researcher and manager in charge of research and tax modeling at KRA in the Strategy, Innovation and Risk Management Department. He has over 10 years of experience in both public and private sector, and has worked with the IRA, the Insurance Regulatory Authority, as well as KIPRA, the Kenya Institute for Public Policy Research and Analysis, and Absa Bank. He has done consultancy engagements with the World Bank, the African Tax Administration Forum in South Africa, and holds a PhD in economics from the University of Nairobi right here in Kenya. A very, very warm welcome indeed to you, Alex. Karibu sana. Also on the panel is Modoni Kimani, a tax professional with over 12 years of experience in taxation across the region, having spent 11 years with the Big Four and currently working as an Africa tax lead for WPP Scanning, which, as you're aware, is the biggest advertising agency, and where she oversees tax-related matters across this continent. She's interested in the enactment of policies and legislation, not only to make sense to taxpayers, but also to ease compliance. She also holds a degree in engineering, so a very interesting mix there. Karibu sana Modoni Kimani, welcome to today's panel. And now internally here at CDH, we have Jerome Brink, a director in our tax and exchange control practice in our Johannesburg office. He specializes in corporate tax, international tax, and tax dispute resolution as well. He also provides advice on a wide variety of commercial transactions and business activities, from financing to corporate organizations, restructuring, disposal and acquisitions, etc. In relation to international tax, Jerome advises various clients on inward and outward investments, tax residency, control, foreign company rules, double taxation, transfer pricing, among others. A very warm welcome, Jerome. We're delighted to have you on our panel. And finally, right here, our Nairobi tax head, Alex Kanye, will be moderating today's discussion. He's a partner who leads our tax and exchange control and dispute resolution team here in our Nairobi office. He's worked in Kenya and Ireland, Europe, Asia, and Africa, representing clients in Europe, Asia, and Africa, and other places of Africa, and other locations within Africa. He also has extensive experience in tax structuring, dispute resolution, tax advisory, risk management, restructuring, legal audits, due diligence, M&A work, as well as company secretarial work, as he is a registered CPS within the country. A very warm welcome to all our panelists. I'm looking forward to a very interesting conversation this afternoon. And at this point, hand over to Alex to lead us in today's discussion. Alex?
Thank you very much, Shem, for the warm introduction. So I want to welcome everyone to this particular webinar, which is like a follow-up to the webinar that we had last time on the draft national tax policy. So today we focus on the 2023 tax outlook, together with some developments that we expect to take place in 2023. We also look at some of the tax measures that took effect on 1st of January 2023. So just to give us a background, our country's GDP, when you look at 2020, 2021, 2022, in 2020, we had a sharp decline. In 2021, we had a slight improvement. And just as we were recovering, then we had things to do with the Ukraine-Russia conflict, the rising inflation, a lot of climate change, and that, of course, has an impact on our economy. And even the projected growth in 2023 is, something about 5.5%. Why that is important is that it also impacts on our revenue collection and tax measures that the Revenue Authority then decides to embrace, so that they raise revenue to meet our ambitious budget. Looking at the estimates that were recently released in December in terms of our revenue and expenditure, we are slightly falling behind in terms of targeted tax revenue, but there's great promise in terms of what KRA intends to do to bridge that gap. When you look at our tax to GDP ratio, we are looking at about 15% 2020, 2021, 17% closing 2022. But we have the plan to also grow this tax to GDP ratio to around 18%. And of course, that will come with certain measures that the Revenue Authority will definitely embrace. And finally, we've had a lot of discussions around the draft national tax policy, the 2023 budget policy statement, and of course, what we expect through Finance Bill 2023. And over and above that, of course, we have a number of regulations that came into effect or are in discussions. Some came into effect on 1st of January, and some others are still in development. And I'm sure our panelists will be speaking about those. So with that background and considering the pronouncements from our current regime, we're looking forward to a very engaging tax space in 2023. We have pressure in terms of budget. We have pressure in terms of inflation, meaning the population is hard pressed to actually spend, so that even the Revenue Authority can collect tax out of that. But I don't want to preempt the discussions that we'll have with our panelists. And with that, I would want to introduce or welcome Josephine Mugure to take us through a short presentation from the Kenya Revenue Authority. Josephine, karibu.
Good afternoon, Alex. I'm going to take you through the changes that were introduced by the Finance Act 2022, which were effective on 1st of January 2023. These are just a few, as most of them had come into effect on 1st of July. So we may proceed. So the changes that came into effect on 1st of January are from the Income Tax Act and the Excise Duty Act. Actually, one is from the Excise Duty Act and 3 are from the Income Tax Act. So the Finance Act 2022 came into law on the 21st of June 2022, and it had two dates. The effective dates of the sections included therein could either have been effective on 1st of July 2022 or 1st of January 2023. And some of the laws that were included in the Finance Act were the KRA Act, Insurance Act, Capital Markets Act, and of course the Revenue Administration Act, that is Excise Duty, VAT, Tax Procedures Act, and the other revenue administration, like the ones that we have recently adopted. The Miscellaneous Fees and Levies Act is an act we have recently adopted to be a revenue act because we administer the fees and levies that are collected therefrom. So this is a background of the laws that were contained in that Finance Act. You may proceed, Karushka. So the Finance Act introduced taxation on financial derivatives under Section 3.2, and this was to be effective from 1st January 2023. And the target group is non-residents. It will be administered as a withholding tax, and it will be at the rate of 15%. So we have since developed regulations to guide on how this tax was to be effected. And before we finish this, we'll be looking at the regulations just briefly. And so this law has come into effect and the regulations are ready. And I've said the target group is the non-residents who are engaged in financial derivative transactions, and we're taxing them at 15% on the gain. And as a result of introducing this change, we had to amend our Section 9, which deals with non-residents, then Section 34 and 35. 34 provides the rates. Section 35 provides that for it to be administered as a withholding tax, and the third schedule provides for the rate, the specific rate for that tax. Move on to the next slide, please. The next change that came into effect on 1st of January 2023 is the changed Section 18A on ascertainment of gains of profits on businesses in a preferential tax regime. What this change did was to widen the scope of who the parties that can be considered to be in a transfer pricing framework. Previously, we didn't have any taxpayers in the same jurisdiction as in our jurisdiction, Kenya, that were considered to be in transfer pricing. But now with the coming to effect of this law, we are seeing that a taxpayer who's actually in Kenya, but in a preferential tax area, can be deemed to be having transfer pricing transactions with another party in Kenya. And basically this was just to widen the scope and also to redefine what a preferential tax regime is. So that's the other law that came into being on the 1st of January 2023. The next change was with regard to capital gains tax, where we changed the rate to 15%, and it was effective from 1st January 2023. And we saw a lot of transactions towards the end of the year, I think in anticipation that the rate was going to change. And so this has been effected. And we've seen a lot of questions from the taxpayers asking us, what if I had concluded my transaction before 1st of January, but I am only paying after 1st of January, then do I pay at 15 or 5%? And we've been guiding as long as you can show us that the transfer had taken place, because this tax crystallizes when the transfer takes place. So as long as you can prove to us that the transfer had taken place, then you'll pay at the previous rate of 5%, even if you're paying it after 1st of January 2023. So those are the changes under the income tax that came into effect on 1st January 2023. So we move on to the next one, which is going to be on under the Excise Duty Act. And this was a change made to Section 10, which allows the Commissioner to exempt certain products from inflation adjustments. Previously, the Commissioner could not exempt any items, and he actually had to seek permission of the Cabinet Secretary. But now, with effect on 1st January 2023, the Commissioner can actually exempt some items. And this was necessitated by the fact that the excisable goods cannot always be reviewed due to the impact they could have. For instance, the petroleum products. If we were to apply inflation adjustment on the petroleum products, the ripple effect would have been too big. And that's why we needed to allow the commissioner to be able to exempt some products depending on the circumstances prevailing. You may proceed, Karushka. So those are the changes with regards to the law. Then recently, we've had regulations come into effect. One of them is the financial derivatives regulations, which were published on the 27th of January, and they are now effective. And as I had explained earlier, they are actually giving details on what is subject to these tax, what is gain, and how will it be administered. They've been published, and so now they're in effect. Then we have the Common Reporting Standard Regulations 2023, which were published on 7th of February, and they are now effective also. These ones are to guide on transactions, especially financial transactions between jurisdictions. Then we have excise duty EGMS amendment regulations, which are in the process of being published, but we had public participation take place on the 1st of February. And these will be seeking to streamline the processes for excisable goods. They'll be seeking also to amend the stamp duty, the cost of stamps, not stamp duty, sorry, the cost of excise stamps on excisable goods. Then we have the VAT, Electronic Internet and DMS regulations. This one will govern the DST environment for e-commerce transactions and internet electronic transactions. This one, we had public participation on the 8th of February, and they're in the process of being published. Then we have excise duty amendment regulations, which are currently undergoing public participation. We had a public participation on the 8th of February, but then the stakeholders asked that they be given more time to submit their comments. And so the time was extended to 21st February. And so we'll have the physical engagement, not physical necessarily, but a virtual engagement on the excise duty amendment regulations on 21st of February. The two excise duty and excise duty EGMS are for the goods regulated under those two acts, and they seek to streamline, to reflect change that has happened over time, to clarify anything that might not have been clear. But most importantly, the VAT Electronic Internet and DMS regulations seek to revoke the previous VAT DMS regulations. For those of you who had interacted with them, you noted that the previous VAT DMS regulations had numbering problems, and because of that numbering problem, it was very difficult to refer to them, because the regulations, inside the regulations, they referred from number 1 to 14. But when you go to the listing of the regulations, it starts from number 14 to number 28. So to amend that and also to reflect the changes in the DST environment, we proposed this change, and these regulations now will revoke the existing VAT DMS regulations. Unless now you have questions, that brings me to the end of my presentation. Thank you, Alex.
Thank you, Josephine, for that presentation. We'll next go to a couple of questions straight to the panelists and to yourself, and also to Dr. Alex, who's also joined us. And then after we've done a couple of questions with the panelists, we'll open it up for questions by our participants. Please feel free to type in your questions as we proceed, so that we're able to also ask those questions directly to the panelists. So to start us off, we have Jerome Brink, and for Jerome, you've heard of the discussions that we've had so far, and what Josephine is mentioning around financial derivatives tax. Do you have this tax in South Africa, and how was it introduced in South Africa?
Hi, Alex. Asante Sane, Alex, and thank you for having me today, and of course allowing me the opportunity to engage with your colleagues and share some thoughts from a South African perspective. Really appreciate it. So I think the first thing to note is from what and again, I'm not, you guys are the experts, but from what I understand, the new legislation from a Kenyan perspective is a withholding tax. And so it's basically a withholding tax on effectively a withholding tax on any gains derived from the disposal of financial derivatives. And from a South African perspective, at least, we don't have a similar type of arrangement in the sense that we don't have a withholding tax. But of course, we do have normal taxation principles when it deals with derivatives that are sort of sourced in South Africa. And I think a few things to really highlight at this stage is the key challenges when it comes to taxing derivatives. And one of them is the jurisdiction to tax, which is, which source is it from and who has the taxing rights. And I think obviously by Kenya introducing a withholding tax, that does away with a lot of those questions and complexities potentially. Albeit that I guess the non-residents wouldn't necessarily be as happy that they're getting the withholding tax. So that's one of the challenges, but there are two other sort of challenges that when it comes to taxing derivatives. And the first one is also to understand the character of the income. Is it being paid in cash? Is it a settlement of an asset? Is it capital or revenue or nature, which is obviously a key question. And in this instance, again, with the withholding tax being at a flat rate of 50% Kenya, it is different to what would potentially happen in South Africa, where those questions are, of course, unanswered. And it would be a facts and circumstance type test. And then I think the third type of sort of issue or sort of point for discussion is really the timing. From a derivative taxation of derivative perspective, that is quite a critical issue. And again, I note that in terms of the Kenyan regulations, it will be at the time of payment and not necessarily accrual. And again, from a South African perspective, it is different in the sense that a payment doesn't necessarily trigger tax either from a deduction or an inclusion perspective. But anyway, these are all significant challenges. And I guess by putting in a withholding tax, a lot of the uncertainty is removed. But from a South African perspective, our sort of taxation of financial derivatives is not really contained, as I said earlier, there's no withholding tax, and it's not really contained in any one section. There's basically a whole number of sections dealing with different types of derivatives. There's a section dealing with option contracts, a section by itself dealing with interest rate swap agreements. But these sections are typically then just dealing with the timing of deduction and inclusion of income. And generally, a lot of the other principles are still sort of leaning on the general principles, which does unfortunately create a bit of uncertainty. But yeah, so yeah, interesting to see obviously the changes from a Kenyan perspective, and to see this withholding tax being introduced, and comparing notes, at least from a South African perspective, where there is quite a bit of uncertainty.
All right. Thank you very much, Jerome. And maybe to Dr. Alex or Josephine, we have people who've joined and they're asking, what is this financial derivative? In terms of a very simple explanation or an example, what would be your response to that? Alex, I see you're coming on. Dr. Alex.
Alex gets on, I can take that. We are just looking at financial derivative transactions. We are looking at the contracts that a person can get into with regard to financial instruments, and these can be futures, forwards, interest rate swap, option contract, option premium, and those kind of arrangements, which will be governed by a contract. And we are looking at that contract and saying, when the Kenyan in the transaction loses and the loss is realized, they claim the loss in their return in Kenya. So, and when they lose, the other person will have gained. And so we are seeking to bring those non-residents when they gain into the taxation bracket, because when a Kenyan gets into a similar contract and they gain, we tax them. So first of all, we are seeking to bring equality in the taxation of these kind of contracts. And then we are seeking to tax it because we allow the loss on our end. So an example, I don't have an example in mind, but that's the simplest way I can put it.
All right, and thank you for that, Josephine. So moving on to excess duty, you mentioned that there have been an amendment basically to allow some flexibility as to what then is can be left off the hook in terms of inflationary adjustments. The excess duty discussion has been there for some time, and there's the feeling that we are almost getting to the roof in terms of excess duty. Any comments that you would give on that in terms of where we are headed or current numbers for excess duty?
I think the only comment I'd like to make about that, Alex, is we do inflation adjustment so that we do not erode the tax base. You realize there are some products whose excess duty is based on an amount, a specific amount, and not on the value. So that when the value changes, the amount of excess duty remains the same. For instance, if you are saying we'll charge 10 shillings per kilo of powdered beer, if the value of a kilo of powdered beer goes up, say right now the kilo of powdered beer, for instance, is 50 shillings, and we are charging 10 shillings per kilo, so we'll be collecting 10 shillings. If the value of the kilo of powdered beer goes up to say 100 shillings, we are still charging 10 shillings despite the value having gone up. So we do inflation to adjust for that loss of base, just to reflect the changing times on products which we are not able to base excise duty on the value. As to the numbers, I might not have them accurate, so I do not want to comment on something that I might not be able to justify. But when we cannot adjust for some reason, like I said, the last inflation adjustment, we did not adjust the petroleum products because of the ripple effect and the fact that the government was already subsidizing the cost of fuel. So it didn't make sense to add costs and the government is the one to pay. We want that flexibility. Previously, we've been able to do it, seeking authority from the cabinet secretary, but now the commissioner at his level can decide. Due to the prevailing economic conditions, we will not effect inflation adjustment on certain accessible goods. Thank you, Alex.
All right, thank you very much, Josephine. And I see our participants are typing in the questions, and we'll get to those questions shortly. Moving on to the tax outlook for 2023, that we're just discussing Finance Act 2022. So moving on to some new things that are coming up in 2023. Muthoni, maybe you could comment on that on exported services. So recently, we had a decision, I believe, by the High Court, and there was a challenge on a number of things on Finance Act 2022, which somehow changed some aspects on VAT on exported services. From where you sit, and having been in the tax space for some time and working for an advertising agency, what do you see as the impact of this VAT on exported services, and particularly restricting that to BPO or business process outsourcing?
Thank you, Alex. I think for us, the biggest challenge of the service industry has been that, one, even when the Finance Act changed last year to classify VAT on exported services under standard rated. And then they said that only BPO services would be, zero rated. We never got a definition of that's reliable, whether it's in the Income Tax Act or the VAT Act, or actually even in the Petitions Act. So that was not helpful at all. And then sometimes some of these measures come in like that one, and then the regulations or the framework takes so long to follow, such that it's kind of counterproductive. And whatever winnings one would have had in that regard, there are none. And so for us, especially as a business, as an advertising business, which is headquartered here in Nairobi, but we have reach directly in about 15 markets and affiliates in an even wider, in more markets, to covering about 75% of sub-Saharan Africa. What we have found is that the VAT is making us not competitive, and actually also bearing in mind, and you laid this out in the intro about the tough economic times that everybody's going through. For us, advertising then becomes sort of discretionary spending. It's not necessarily, and companies are not choosing, they're not choosing to allocate more money to advertising, and if anything, they are reducing it. So what we have seen is what ordinarily, for example, would cost, say, 100, the client is reducing that 100 to, say, 80, but the 80 must now also cover and must be inclusive of taxes, the 16%. So we find that our revenue, which previously was 100, is now 80 less 16, so it's about 64. And that for us has really affected our bottom line. We are listed here publicly, so even from, and I'm sure the Revenue Authority has been checking out our published results, that is also something that has affected us. And this is not just us. A lot of other multinationals which have had shared service centers located in Kenya, some of them have had to relocate. I know a couple that have moved to Dubai and the like, simply because, we are not, Kenya and the policies that we have are not competitive. And the policymakers also are not looking at the wider ramifications of the policies they put in place. And I think that, and this is one of the things I am hoping that in the upcoming budget policy statement, the CS Treasury is going to put back VAT on exported services back to under zero rated. And I think that the other case, just arguing for that, is Kenya for VAT, we use the destination principle of charging VAT. And so this particular reclassification of exported services under standard rated was kind of, not in harmony with that. That's not in, it's not in harmony with the global practice on charging VAT or what we have with regard to goods.
All right. Thanks for that. So I'll come back to you shortly on what you think around minimum tax and the current challenge at the Supreme Court. Perhaps we may not discuss much about it, but just to get your thoughts around, is this one of the measures that the government could reintroduce when you think about the Finance Bill 2023? So I'll come back to you on that. But even as I do so, and sticking to VAT, and this is a question to Dr. Alex, we have heard of the move from Teams to e-Teams. What is this move all about? And will it solve the current challenges where you have guys struggling to get ETR machines or, auto population, and, the link to carry systems? Sometimes people also say it's problematic. So what's this move to e-Teams and what will it achieve?
Thank you, Alex, and thank you everyone for joining in on this webinar. Yeah, so one of the administrative measures that Kenya Revenue Authority is taking, our revenue collection, particularly on the main tax head, that is the VAT, is the implementation of Teams. And recently we had a team that visited Rwanda to benchmark with them, and we noted that for them, they they moved away from teams and they have. Can you hear me? I can see someone saying can't hear.
Yeah, just increase the volume. Can't hear you well.
Yeah, so we have been implementing teams, and not all modules have been rolled out, so it has not been fully implemented. However, our benchmarking with Rwanda shows that we need to move to a better system which has more provisions. Like for Rwanda, they have a system what we can call e-teams. It's a platform whereby the taxpayers can. It also helps the taxpayers to manage their invoices, and so acts in a way that any transaction that is done at the point when that transaction is done, it is transmitted directly to the platform of the Revenue Authority, and therefore it becomes very easy on the part of even the taxpayers to reconcile their transactions. So what happens is that this has enabled them. It has even made them. It has made it easier for the taxpayers to manage their invoices and to reconcile their transactions. And one point that they pointed out to us was that the marketing point of this system when they were rolling it out was that going to help the taxpayers to properly manage their records, and therefore most of these taxpayers registered and embraced the system. And so this is where we also want to move teams, whereby now the transactions that are carried out at the point when the transaction is carried out, this is also reflected in our systems, and therefore it becomes very easy to reconcile the transaction. So it will make it easy for use the paperwork substantially. It will make it easy for the taxpayers also to file their transactions, and it also make it easy for us to also trace the transactions, as opposed to the case now where we have to wait after 20th for the taxpayers to come, and filing is quite a tedious process. So yes, movement to e-teams is going to help us to compliance, and also going to help us to have a wider view of the transactions that are going on.
All right, thank you very much, Dr. Alex. I see the questions that are still coming up, so we'll be addressing those questions in the next few minutes. So there's a question for you, Josephine, around the draft 2023 budget policy statement. And the question really is towards what policies does the government intend to introduce to foster manufacturing or improve on the growth of manufacturing and its contribution to our GDP based on the budget policy statement. Is this something we could comment on?
Thank you, Alex. I'm at a loss to say anything because of my position. If I comment on the budget statement, it will look like it is low because I sit in that committee, and therefore I'll respectfully decline.
That's a fair comment. And Jerry, against this backdrop of what we saw in the budget policy statement, there are a couple of measures there, but what do you think should happen to basically encourage the manufacturing sector to grow? Sorry, I meant Mudhoni.
Hey, Alex, hope you can hear me. So I think around manufacturing in general, there have been a couple of pronouncements, I think by the CS Moses Kuria around the investment promotion levy, which, you know, I guess it's supposed to, as being touted, it's supposed to promote export, maybe shield local manufacturers from, you know, other, you know, imported goods. But I think that while that as a concept might be a good concept, I think that it's not lost on everyone, even without this levy currently, that there is a lot of other things that affect manufacturing. For example, the cost of power is quite high. Other things like fuel costs, they're so high. Things like, for example, excise duty on importation, sometimes of raw materials, or going through the onerous process of being charged excise duty and then having to apply for remission thereafter. I think that while sometimes some of the CSs or politicians or whoever is funding a particular policy or pushing for a particular change, while all those policies should be considered, I think that as an approach to tax policy, we need to avoid short-termism. And even for the policies that we pass, we need to look at them in light of all the other factors. Putting up, increasing excise, and I'm sure there was a round, I think there was a clip that was doing rounds, those that saw it last week and the week before that, around the cost of beer by one of the biggest manufacturers on the continent, on what constitutes the price of a beer. And it was very surprising to me that that particular person was saying that for them, the cost of producing a bottle of beer, the tax cost itself, tax cost alone, was higher than the gross price of the product across the border, right? I think that we need to relook at, when we're passing policies, we need to look at how competitive we are making our economy. And this is not just a manufacturing question, but it's a wider issue. It goes back to what I was saying earlier on when we levy VAT on export of services. I think that we need to stop with the short-termism, and we need to look at whatever policies we pass, we need to think about them on a more global scale and not just the item in isolation, because you might be giving with one hand and then you're, you know, robbing with the other one. And so as a net effect, you really haven't made any positive change from a net effects on the economy perspective.
Thanks for that, Muthoni. I want to move quickly to one of the discussions that we've had in these countries, taxing the informal sector to increase the tax base. And at the same time, we've had a lot of discussions around taxing wealth. So maybe Jerome, from where you sit in South Africa, do you have taxes that specifically focus on the informal sector or the low-income earners, and also taxes that focus on the high net worth individuals?
Thanks, Alex. Yeah, so from an informal sector perspective, it is definitely something that I think from a South African perspective, it's also been a great challenge, you know, how to tax the informal sector. And we do have a number of regimes there, depending on the sort of gross income of that small entity. There are different types of regimes that an entity can sort of apply to, which makes their taxation a lot simpler. So, for example, I think the last I checked, it was under about R1 million income. You could use the turnover tax, which is very simple, and you basically just pay sort of flat rate on your turnover, and you don't have to deduct expenses, and it's very simple. So there is that aspect, and then there's another few other sort of regimes on that to try and make it easier and simpler. And that they don't have to, that's, you know, the informal sector doesn't have to deal with very high complexity of taxes, which is obviously always the case. That doesn't always, unfortunately, result in the informal sector being taxed to the extent that you wish, but there are certainly some provisions that do make it easier for them. From a high net worth individual perspective, yeah, look, it's been a subject of great debate here in South Africa for the last sort of 5 to 10 years, whether there should be a wealth tax. And I think I do remember saying previously that there are potentially sometimes already wealth taxes in South Africa. We have a transfer duty, which is basically when you purchase property, you have to pay a portion of the purchase price of the immovable property to SARS. And in essence, that is a type of wealth tax. But it doesn't look like at this stage that there will be some type of wealth tax. South Africa does have quite a sort of progressive tax marginal rate scale. And at the time being, the policy does seem to be that wealth tax is not really going to bring enough income, and the margin of diminishing returns is not really going to be attractive. Having said all that, SARS does focus on high net worth individuals. They have a specific unit for high net worth individuals, so they are very much on the radar, and there have been sort of other amendments made to specifically trusts and offshore structures involving trusts, etc., in the last few years, which have indirectly had an effect on high net worth individuals.
Thanks for that. So with those few remarks, I want to welcome Dr. Alex to make a very short presentation for about, I believe, 5 minutes. Make it very short so that we take the questions then from the participants.
Thank you, Alex. I'll present to you the tax revenue outlook for the financial year 2023, for the year this financial year and even the next financial year. So, as a background, is that as KRA, our focus currently is on these 3 aspects, which are the pillars of our 8th corporate plan, which is running until the end of next financial year. That is tax simplification, to make it simpler for the taxpayers to comply. Issues with the technology-driven compliance. That's why we are also implementing. We are focusing on rolling out e-teams and also supporting customs based on technology platforms like e-CMS and the rest. So we're also focusing on tax-based expansion, and this brings on board the issues with the taxation of the informal sector, taxation of the digital economy, and all that. So next slide, please. Yeah, so I'll not take much time on this. This is just a snapshot of the macroeconomic environment that we are in at the moment. Some historical data as well. And this, Alex, in his introductory remarks, had mentioned how our economy is on a recovery. It's recovered to 77.5% growth in 2021. However, there is a slip in 2022, and even in this financial year, we expect a slight slip to around 5 point something. So for the exchange rate, we have noted that the Kenya shilling has been weakening over the years, especially last year, for the last 1 year. And also the inflation rate has also increased. And another positive thing is that we have also had increase to credit, access to credit by the private sector. So the first 3 graphs actually show that there are some indicators that impact on the nominal value. As you all know, tax is a nominal item, so the impact on the nominal value of the tax revenue. We have a model that we use to project the revenue that we can collect as these macroeconomic variables change, and so this points to an increase in nominal value of the taxes that we'll be able to collect. Next slide. Yeah, so in the first half of the financial year 2023, we have been able to attain 96% of our target, 0.1 for the overall tax revenue and 0 for exchequer revenue. And the most important thing is on the growth, because the revenue by 10%. Yeah, so for the remaining year, half of the year, we are looking at we require.
Dr. Alex, maybe you could increase the volume a little bit. We are struggling to hear you.
Okay, thank you. Let me hold the microphone next to my mouth. And so in the next half of the year, we expect to grow the revenue by at least 9.8%, so as to meet the targets that we were given at the beginning of the financial year. Next slide. So this just shows the tax effort in the country as compared to other countries. As African countries, we can see that we are not performing well in terms of our tax to GDP ratio, as most of the countries are at 16.5% or below, and as compared to the OECD average of 34.3%. And I think the only country that could be performing well is South Africa, which could be having around 26% on average for the last 5 years. And for Kenya, in the East African region, Kenya is performing better than the counterparts in the East African region at an average of 16.1%. And so, as a revenue authority working closely with the National Treasury, we are developing a medium-term revenue strategy that we hope to use to drive the growth of tax effort in the country to about 25% of the East African agreed target for the East African the convergence criteria in terms of integration within the East African countries. So, to the next slide. Yeah, so basically this shows where we are moving. So in the current financial year, we have a target of about 2.3 trillion, and we have administrative measures as well as policy measures that Josephine has tackled, the policy measures that we are implementing so as to attain that target. And we also have administrative measures like the e-teams I was talking about, full implementation of teams. We have integration that we are trying to do within the government agencies and even with other third parties like the betting firms, the telecommunication companies. This is just to help us to have a view of the taxpayers and the transactions. We have tax-based expansion focusing on informal sector. We have some measures that are recruitment that's currently going on, like the recruitment of landlords that is focusing on monthly rental income. And we also have a strategy that we are implementing to reduce the VAT gap. And for customs, we also have the technology that we are implementing. We are automating most of the customs processes so as to help us facilitate trade as well as collect revenue. And in the next financial year, as most of you may be aware, we target the target is to collect 3 trillion, and at the moment we are already working on strategies to attain towards attaining that target in the next financial year. Please move to the next slide. Yeah, so basically these are the factors that are likely to impact on our revenue outlook in the current part of this financial year and the next financial year, and this includes the realization of the full implementation of the Finance Act. Part of it was implemented from July, and part of it is being implemented from the bit that is being implemented from January. We expect to generate around 8 billion. Then we have the administrative measures that are listed there. When they are fully implemented, we expect that they'll help us to improve revenue collection. And of course, as the proxy base for our taxation, it is the economic performance. So we also look at the performance of the economy impacting on revenue, depending on other external factors, both internal and external shocks that could impact on the economy, like high energy cost, the continued war in Ukraine, supply chain disruptions, and the rest. So the Kenya National Bureau of Statistics projects a growth of around 6.1 in 2023, and in the last quarter, in quarter 3 of 2022, they reported a growth of 4.7. So you can see that the economy is kind of a slowed growth, but we hope that we'll be able to attain the projected 6.1. And so from on this, we have some kind of optimism about the growth prospect. I will not go into detail on each of the sectors where we are having some optimism, but what is key to note that the performance of the economy will actually be a major factor in which will impact on the revenue that we are likely to collect. Let's move to the next. Okay, so that's my final slide, and this is about rationalization of tax expenditure. We have been monitoring the tax expenditure over the years, and as you can see in that graph, the tax expenditure to GDP ratio has been declining, and it declined from 5.2% of GDP in 2017 to 3.2% in 2021. Currently, it's at around 2.5%, and we hope to reduce this to below 2%, which is like the acceptable percentage as proposed by the IMF. So we are working towards also rationalizing the tax expenditure, because tax expenditures or tax exemptions are actually revenue forgone. It's revenue that we could have collected, but it's revenue forgone to try and incentivize some of these sectors. So we are also working towards that, and we have had sentiments on issues to do with tax exemption, which is welcome, and we hope that this will also help us now to try and also further rationalize the ones that are even remaining. Thank you, and back to you, Alex. Thank you.
Thank you very much, Dr. Alex, for that very short and sweet presentation. I want us to go straight to the questions from our participants, and for our participants, I'd want to request us perhaps to stay on for an additional 10 minutes after the scheduled time. We are meant to end at 3:30, but gauging by the number of questions and interaction, I think we may need to just take a few more minutes. So to Josephine, please comment on the question from Winnie on DST, whether it's final tax and applicable to both residents and non-residents. Josephine?
Sorry about that, Alex. I had typed in the chat, but yes, I can comment. GST targets non-residents, and it is a final tax, and it is at 1.5%.
Okay, thank you very much for that. There's a question here around VAT, and I don't know whether you'll be comfortable with answering this, Josephine. Since the VAT Act doesn't define BPO, but we have a definition within the SEZ Act, does it mean that we defer to the SEZ Act to know what is meant by BPO, business process outsourcing?
No, the fact that we don't have a definition doesn't mean we refer to that, because the SEZ Act defined BPO for their own consumption, not necessarily to cater for tax purposes. Therefore, what KRA has been doing is inviting the taxpayers, whoever thinks whatever they're doing is BPO, let them write to KRA, and we guide on a case-by-case basis. Then if we get back to you, and we do so in good time, then if we are satisfied it's BPO, we'll communicate it's BPO, and then you'll be charged tax at zero. If it's not, we will tell you, and then you'll be subject to VAT at the standard rate.
Well, thanks for that. I think it's an avenue that many people didn't know about. Then on things to do with the draft national tax policy, sorry, back to you, Josephine. I know there have been discussions that have been going on. Any idea as to when we will have it?
I cannot say a specific date, but we have actively been working on it. We did stakeholder engagement just last week. We finished meeting taxpayers physically to bring their proposals, and so now we are incorporating those changes, what we can incorporate. and we are on it. I can't say a date, but I can assure you we are working on it. The National Treasury and the government is keen to see that this document is finalized and available for use.
Thank you very much, Josephine. To you, there's a question for you, Dr. Alex, around Teams. Is there a current reprieve? Vusi is asking whether there is a current reprieve for companies who have not been able to automatically create ETRs but have been paying over the correct amount to KRA. Anything happening in that regard?
Yeah, thank you. I think I might not be able to satisfactorily respond to that, but what I understand is that we have had companies that had challenges in connecting to the system, and so for these companies, as long as you have been filing using alternative means and also paying the correct tax, I think there's no problem with that. And for the e-teams, it was rolled out this month, and therefore I think there's still a grace period. I'm not sure of how long, but there's still a grace period for the taxpayers to onboard. And because of when rolling out new technologies, there are always challenges to do with connectivity, compatibility of the systems. So there is always a grace period for taxpayers to onboard, as long as they are just meeting their tax obligations and also filing in time and correctly. So I'm not sure of the period, but I think there is kind of reprieve as long as you don't have issues to do your self-assessment and declarations that you're making and payment. So that's what I can.
And maybe final question on the move from Teams to e-teams. Does this mean that the machines that have been bought by taxpayers to basically implement Teams will go to waste if we then implement e-teams?
Yeah. For e-teams is like a web-based software of which you can access it using various devices. So those devices will still be useful, just the same way you can connect to our. Can even use your computer to access that platform. You can also still use those devices. So you have the good thing with the e-teams is that now it gives you various options. So you don't have to buy that ETR machine to access that platform. So you can just use your laptop and access the platform, or integrate it with your billing, your accounting system, so that the transactions are reported to KRA. So you don't have to, if you didn't have the ETR machines, you don't have to buy one. You can use any other device, provided it's able to connect to that platform.
Thanks for that. To you, Jerome, there's a question around financial derivatives and whether guys can take advantage of for example, the treaty that we have between Kenya and South Africa. So what happens in there?
Thanks, Alex. Yeah, so I think Josephine did have a quick answer to that in the chat. And I don't think the normal sort of withholding tax reductions, in the sense of withholding taxes on interest and royalties and dividends would probably apply. So you would have to maybe have a look at something else, potentially, as has been mentioned by Josephine, the business income, what the derivative looks like. But yeah, it's a very good question, very interesting question, and certainly no straight answer, and something that should definitely be looked at in more detail, also depending on the specific DTA in mind. So, for example, the South African Kenya DTA, I know that capital gains that are not otherwise dealt with, if it's not a capital gain for immovable property and that kind of thing, it is then it can only be taxed in the country of residence, so the person who's resident. And then the question is, would that maybe help? I don't know, because the derivative, as we discussed earlier, is often seen as a revenue gain and not a capital gain. So that's also a question as to whether that would apply. So yeah, more questions than answers, I'm afraid, but definitely something to consider, the DTA impact of that withholding tax.
And sticking with you, Jerome, and sorry, we hadn't spoken about this around carbon tax. So maybe in just a minute, why did South Africa introduce carbon tax? And as you respond to that, I will rope in Josephine around what are her thoughts on carbon tax, considering the draft green incentives policy that has been issued by our National Treasury. So just in less than a minute, why did South Africa introduce carbon tax?
Yes, thanks, Alex. I think there's probably two schools of thought. The one is that it's just to increase revenue in the same way of sugar tax and all these other types of taxes. That's the one school of thought. The other school of thought, of course, is that South Africa is also signatory to all these global agreements in terms of combating climate change. And there are a number of provisions in the Tax Act already to change behavior, but the carbon tax was obviously one of the key ones to really enforce the change of behavior and to combat climate change.
Josephine, any comments on the draft green incentives policy and carbon tax?
I'll give my personal view as Josephine. I think carbon tax is catching up. Everyone is looking to see what is it, what will it do, even at the EAC level, and the companies are looking to see whether they can trade their carbon credits. I think it's a vibrant place to be at with regard to carbon tax, and I personally am interested. I'm really following it up at a personal level.
Thanks for that, Josephine. In fact, our firm will be releasing an article on carbon tax in a few weeks, and we'll discuss that in more detail. Back to you, Modoni, in terms of first a comment on minimum tax, whether you think there's a shape that we can still have it, and finally, your thoughts around what to expect in Finance Bill 2023.
I wanted actually, before that, to comment on carbon tax, what I think. I think that, if you allow me, I think that while, in January they released that draft bill on a green fiscal incentive, I mean, ESG in terms of globally is catching on. It sounds like a buzzword. But I think for a lot of countries, particularly in Africa, for a long time, it will remain exactly that, as a buzzword. And why do I say that? For the last maybe 20 years, there has been a lot of conversation around international tax and transfer pricing. And I find for a lot of revenue authorities on the continent, there's still not enough skill set or manpower for the revenue authorities themselves to govern and regulate and assist with compliance around something as direct as, I'm not saying it's simple, I'm just saying direct in terms of revenue. It's directly related to customs, to withholding tax, to VAT, and to ultimately, of course, income tax. So if revenue authorities have been struggling to date with modalities and skill sets and upskilling around transfer pricing, for example, and international tax, do you honestly think, from a revenue projections perspective, what would be expected to be collected from carbon tax? Do you think that that's going to happen? I personally don't think so. It's a nice thing to say in terms of academic pursuit. It's a nice draft policy to have, but I don't think that's going to happen in the next 5 years, to be honest. And I don't think from a revenue expertise, revenue justification perspective, that's something that we're going to see soon. Anyway, so that's that. That's my comment on carbon tax. So moving on to minimum tax, yeah. So minimum tax, I think currently the carrier has already appealed. I think the case is at the apex court. They have lost the appeal, but obviously there hasn't been hearings or proceedings in that regard. Do I think it will come back at some point? I think so. That's not to say that I necessarily support it, but my view, will it come back? I think so. And I think some of the ways they could improve it would be, for example, to come out with a clearer framework that doesn't seem like it's all catching and all punitive. For example, like in Tanzania, there is some of the provisions they have around that is for companies, I think startups or companies that are younger than 7 years, thresholds. They are not charged minimum tax. If, for example, at some point you do have some years where you have tax profits, then minimum tax doesn't start until the third year of 3 years of consecutive tax losses. Yeah, and then the rate could be lower. I think what was proposed from the Kenya aspect was 1%, but I think Tanzania we use 0.05% or something like that. So I think, do I think minimum tax? Do I agree with it? I don't like it. I don't want it. Will it come back? I think so, yes. But there is ways within which to ease its implementation to make it more palatable. So that's my comment on minimum tax. What do I hope to see in the budget policy statement coming up? I hope to see reclassification of exported services to align with the destination principle. So that takes them back to zero rated. And I know a lot of our attendees have talked about it in the comments. And it's a great concern for us ourselves as a business, as WPP, and I'm sure for a lot of other professional service providers, such as Cliff and Decker and a lot of other advisors that have regional presence. I do hope to see, as I said earlier, I would like to see policies that you don't give with one hand and take away with the other. So a lot of I expect to see harmonious passing of policies, and from a personal perspective, I would like to see a widening of tax bands from a PAYE perspective. I would hope, it's a long shot, but I would hope to see the same way our colleagues from Kerry, Alex, and Josephine have been talking about the adjusting of a base with inflationary adjustment for excise tax purposes. I hope they do that for PAYE as well, not just for the tax basis, but also the tax reliefs and other incentives and that sort of thing. And one more thing on, and I know we're running short on time, is interest restriction around deducting of interest expense. Could Kerry kindly take that back to only be interest expense on loans by non-resident related parties? Because I feel like the spirit of that particular provision was about taxing at source, or in the spirit of to prevent base erosion and profit shifting, and usually that would happen between related parties. And for local lenders, why are you restricting interest expense from loans granted by local lenders? After all, when I expense the entire interest, you're going to tax it from a CIT perspective on the bank or whoever is lending me, because they're within the jurisdiction. Anyway, just three or four of my most pressing matters, but we're short on time, and so I'm going to stop there. Thank you, Alex.
Yeah, we are coming up to the end of this particular webinar. Many thanks to our panelists and our participants for those great discussions and the questions. I'm sure we've learned one or two things from this webinar. So looking at 2023, of course, you've heard about performance in terms of our revenue and our ambitious targets in terms of what we want to get to finance our budgets. We've heard about KRA employing technology to basically collect tax more efficiently and effectively. We've heard about the lots of regulations coming up in 2023, some of them already in progress, CRS regulations, some VAT regulations, some excise duty regulations. We've seen the financial derivatives regulations as well. Of course, we are looking forward to a very interesting finance bill, if I may call it, in terms of the tax measures that the government will perhaps implement to go hand in hand with the bold tax pronouncements that we've had over time. Carbon tax, of course, is something to look out for. Whether it comes out this time or next time, we'll we'll wait to see what happens in that particular space, but you can all confirm that climate change is real and we are actually feeling it wherever we are. Something else, of course, that we expect to see, and based on what we've heard the government say, is some reduction in terms of the tax exemptions that we have, or elimination of some of those. So something that is likely to also happen within 2023. And even as I close, maybe Dr. Alex, Josephine, you could consider whether we could have another voluntary tax disclosure program covering 2021 perhaps to 2023. We saw that KRA collected some revenues, some good revenues out of that particular initiative. It's something that is coming with Finance Bill 2023. We'd welcome that as well. So with that, I think again, thank you very much for attending. I hope you've already answered our poll questions. We look forward to hosting you for the next webinar. Of course, we'll share the recording, and if we get the slides, we'll also share those across. Thank you very much and have a nice evening. Goodbye.